Introduce the Empresarios program team. I'm Alex Valle. I'm the program coordinator for the Empresarios program, and I provide technical assistance and just administrative support. And yeah, team, if you can please introduce yourselves, maybe just your name and your title, and then pass it on to the next person. Melina, would you like to go first?
Sure, yeah. Hi, everyone. Melina Romero. I am the Empresarios Program Manager. Thrilled to see again so many clients here. I'll go ahead and pass it over to Lizette.
Hi, everyone. My name is Lizette Picasso. I'm a business advisor. It's so happy to see everyone here. I'll pass it over to Juan. Sorry.
Hi everyone, I'm Juan Vildosola. I'm also a business advisor with Hacienda CDC, and yeah, I'm excited for tonight's session.
Awesome. Thank you so much. And yeah, do you know if Robin?
Yeah, Robin should be here in about 3 minutes. I do
Great.
want to introduce Marisol as well. Marisol is
Yes.
providing interpretation in Spanish tonight. So for those of you that would like to hear her speak in Spanish, you can go ahead and select the Spanish interpretation button at the bottom of your screen.
So, Melina, while we wait, do you think it's a great idea to just maybe have some people introduce themselves?
Yeah.
All of you who are new, perhaps, that are not part of the program, if you would like to go first, just turn on your camera, introduce yourselves. Let me pause the record de nuevo. Okay, thank you so much for sharing. Now I would like to introduce you to our first guest speaker for tonight. His name is Robin Wang. He will be speaking on financial forecasting. Robin, I know you've been waiting, so I'll pass it over to you. And maybe you tell us a little bit more about yourself, and just your background.
Sure. Thank you for the introduction and thank you for having me here. It's always a pleasure to be sharing information and knowledge with this group. I think this is like the sixth or seventh time I've been here, so very happy to be here again. I am a advisor in Prosper Portland's Inclusive Business Resource Network, IBRN, and my focus is primarily around financial planning and forecasting and capital advising. The two go kind of hand in hand. The financial planning and forecasting involves, helping businesses plan their finances and help them make decisions and, help them plan for the capital that they may need for their business. And then the capital advising work, focuses on helping businesses, identify how much capital they need, what is a good source of capital, what is a reasonable request, help through the planning process and potentially help businesses apply and use the funds that they may be able to get from getting a loan. So today I will be focusing on the financial planning and forecasting piece of it, which I love, but I know a lot of business owners do not. And so I think this is a very important topic. My background, aside from it being a advisor here, I am a former business owner myself. I had my own business for about 10 years. And then I ran a nonprofit organization that supported minority and women-owned businesses for about another 5 years. So, very familiar with kind of the business, entrepreneurship, running a business perspective. And I am not an accountant, so you don't have to worry. I'm not going to use a lot of fancy accounting terms today. I'll try to kind of keep it reasonable and focus on what business owners may need. Before I go, can I just have a time check? When should I be planning on wrapping up and Q&A? Oh, you're muted.
Sorry, Melina, do you want to give your idea? I'm thinking more around like 6 something.
Yeah, I have it here. It looks like right around 6:15, because we'll be taking a break right around then. So
Okay.
maybe 5 or 10 minutes in advance in case there's any questions at the end would be great.
Okay, perfect.
Thanks, Robin.
Thank you.
Thanks, Robin.
So I will share my screen. I have some slides, and I believe these slides are available, and there has also a Spanish version. Is that correct?
Yes, we will be sending out the presentations tomorrow at
Okay.
some point via email.
Okay. So this will be in English, but there is a Spanish version available. All right. So today I'm going to focus on financial forecasting and with a particular focus on startups, new businesses, young businesses. Um, financial forecasting is needed by every business, by every size, but there are some particular challenges that are make it a little bit more difficult for brand new businesses, and we'll go into why it is. But I'm focusing largely on businesses that are still kind of concept phase, or you're still thinking about, or you're just about to launch. Or maybe you're in your first year of business and you want to start thinking about your next, 6 months, 12 months planning. So it's really intended for young businesses. And today's agenda is really kind of split into two or three topics. One, we'll spend the first half talking about what is forecasting and the types of forecasting that you can do. And then we'll talk about how to forecast, especially for a young or startup business. And then, time permitting, we'll go into a case study and talk about some scenarios, and we have some resources that you can download to kind of help you think through that initial process. And I'll stop. We have a Q&A at the very end, but I'll stop at a couple of points along the way to see if people have any questions related to the topics that I just covered. And yeah, if you want to either raise your hand or put something in chat, I'll respond to it when I have a break.
I will be monitoring the chat as well, and so I could let you know.
Okay, perfect. Thank you. Oops. Okay, so first is, what is forecasting? Let's talk about what forecasting is not. Forecasting is not a random number or something that you guess or make up. A lot of people think, oh, I'll just make up some numbers and put some numbers that look good, and that's my forecast. That is not a forecast. That's just random numbers. So we'll talk about what distinguishes a random number versus, kind of an informed guess or informed assumption. The other thing is that forecasting is not precise or perfect. You will be wrong, and hopefully you will be wrong. The forecast is what you predict, what you foresee as the future, and none of us have the ability to do that. And if we did, we wouldn't be sitting here because we would be probably pursuing much more profitable enterprises. So the idea for forecasting is to kind of, help you set a direction, help you think about your plans, help you think about your goals and outcomes. But it's not intended to be perfect or precise. I've seen a lot of business owners kind of spend countless amount of time trying to fine tune and constantly update their forecast. And while it's important to evolve your forecast, it's not important to have that exact money down to the penny or to the dollar. It's just meant to kind of give you a tool to guide you where you want to go and have conversations around that. Let's focus now on what forecasting is. Forecasting, especially for a young business, is an informed guess based upon realistic assumptions. So the distinction between informed guess and guess is you just make a number up. Informed guess is that you take some information which may not be solid, but it could be gut feel, it could be just kind of your observations. You take some data that's around your business, kind of around what your objectives might be, and you apply some assumptions that are realistic to generate some numbers for your forecast. So thus I say it's an informed guess. It's a goal, but not a commitment. As I said earlier, it can and will change. So if it was a commitment, and you missed your budget or your forecast, you kind of feel bad, and you shouldn't feel that way. You should see your forecast as something, as a goal, as something that you want to pursue, as a North Star, for you to pursue, but don't view it as a commitment, because as I said, you will fail. It won't be right. And, the goal of this exercise is to give you a direction and not feel bad that you didn't achieve your goal. So really think of it as a goal. It is constantly evolving, maybe not every minute, right? But, week to week, month to month, right? Your plans may change, conditions may change. There is food. There's sorry, not food. There is snow coming up in the forecast. And any of you that might have a food cart or a restaurant, you know that snow can be disastrous for your revenue. So conditions around your business could change, and maybe the next week you'll have beautiful sunny weather, and people will be rushing out to take advantage of it, and your revenue or sales might grow from there. So conditions change. And I think also your assumptions could change. You are constantly learning about your business, and you may make some assumptions early on that are incorrect, or a little bit too high or a little bit too low. And as you learn more about the business, you can learn more or fine tune your assumptions. So, I would recommend that at a minimum, especially for a young business, you take a cursory look at your forecast on a quarterly basis, and just kind of tweak the numbers a little bit just to make sure that it's aligned. But if you're inclined to, or if you make a big change, and next week you make a big change to your business, then that would be a good time to evolve or update your forecast. A forecast is also a means to measure progress. Again, it's not a commitment, but it's just by setting a budget or by setting a forecast, you're identifying milestones for your business. Maybe it's the amount of sales that you have, maybe it's the amount of expense that you have, maybe it's about some of the other numbers that you're tracking with your forecast. It allows you to just kind of measure your performance, the actuals, versus what you plan to be. And again, it's just a tool for you to just see your progress. And that again could evolve over time. You might see yourself constantly selling more than you anticipated, and that's a good thing. And that might say, okay, my sales are doing better than forecasted. I'm going to increase my forecast in the future, and maybe I can now afford to make these other changes to my business. So it's a means to measure progress. Another thing that forecast needs to be is achievable and realistic. You don't want to set a forecast that you just can't achieve. If you are just starting out at a food cart, it's probably unrealistic to say, in 1 year I'm going to sell, $1 million, dollars worth of goods. That is just, I guess, possible, but it's probably unlikely. That's just too much of a growth for your typical, food cart. So you want to be achievable and realistic, and by working with some of the advisors here at Hacienda CDC, they can give you feedback as to is some of your plans and goals achievable and realistic. They might say, whoa, this is too much, or they might say, you know what, we've seen other businesses that are able to do more than what you're forecasting. So it's a great opportunity to get their feedback and incorporate it into your forecast. And the last thing about your forecast is it is defendable. And this is really important when you're seeking money, capital, because you're going to have someone, whoever you're talking to about funding, they're going to look at your numbers and they're going to ask you questions. They're going to say, why do you think you can have this much sales? Or why do you think that your costs are going to be this low in 3 years? So you need to tell the story. You need to be able to defend your assumptions, your plans, the numbers that you're putting into your forecast, and explain to them that these numbers make sense because this is my plan and this is my rationale. If you're not looking for outside capital, it's not as important to be defendable. but definitely if you're seeking capital, you're going to people who are you're talking to, they want you to kind of explain and defend the numbers and the forecast that you put in. And the last thing I'll say about forecasting is that it is okay to have multiple forecasts at a given time to accommodate different scenarios. So, for example, you could you could be opening up a food cart and things are going well, and you have an option. Someone presents you an option. They said, someone says, hey, I'm selling my food cart. Are you interested in buying it or leasing it to expand your business? And so, if you consider that opportunity, you can develop a forecast based upon a food cart. And then maybe a week later, as you're kind of contemplating this new food cart, someone else comes to you and says, hey, we got this great deal for a brick and mortar. It's in this section of town, and they're really looking for a business like yours to be in there. And at that moment, if you're interested, then you can develop another forecast that looks at that scenario, right? The financials that go into a brick and mortar type business is very different from the financials that could look into another food cart. So you can start today, but then develop two different forecasts that look at those two scenarios, and then you can compare. You might say, well, this is a little too risky, or this is a little too expensive, or maybe the numbers don't pan out for one of the opportunities. But the point is that you can have multiple forecasts to accommodate different scenarios. In my example here, I presented two different opportunities, but maybe you might think, what if I invest a little bit more money in my marketing? And so you can kind of do a different forecast to show to accommodate the fact that you might have more customers if you spend a little bit more money in marketing. So so it's important to use forecasting as a tool to evaluate a couple of different opportunities or decisions that you may be making. Oops. All right. So let's talk about the types of forecasts and talk about what you can forecast and why these are important. So why forecasting? The first and most basic sense is the business profitable? Are you going to make money? Right? We're all in contemplating businesses because we want to make money. There's nothing wrong with it. This is America, and this is how the economic system works. But just because you have an idea doesn't mean that the business is profitable. So you want to be able to put together a forecast to help you assess, does this business can it ultimately be profitable? As part of that exercise, a question that often comes up, especially for new businesses, is, am I charging enough? You might be charging $10 for a meal, and you're thinking maybe I should charge $12, or maybe even $14 for that meal. And so, what a forecast can help you do is kind of look at those different scenarios and look at different pricing scenarios and say, what if I charge $10, $12, $14, and look at how those numbers may pan out. And you may find out that you're not going to make a profit at $10, but $12 is good. And then $14, you might say, I'm going to lose too much business to competitors because I'm charging too much. So it's an opportunity to explore those different pricing scenarios. And along the same lines, it's allowing you to test different assumptions. We talked about just a moment ago about assumptions around pricing. But you can talk about you can factor in other types of assumptions like if you have a retail business, foot traffic and how much foot traffic that passes by your store is critically important. And so you can make some assumptions and around that. You can make assumptions around marketing and the effectiveness of marketing. Many businesses are seasonal. That is, they have better certain months of the year. Sales are better than months of the year. And if you're a new business, you may not know the seasonality. So you can make some assumptions, look at how it appears on numbers on paper, and then you can say again, is this good? Is this not good? And then make plans or changes to your plans to accommodate that. You can use forecasts, as I mentioned a few moments ago, to look at different scenarios or evaluate plans. And in addition to, kind of mapping out whether a plan or an option is profitable or not, by looking at the different scenarios, you can also get a sense for the risk. Oftentimes, I will recommend when someone is considering something new, put into your model, put into your forecast, best case, worst case, and likely case. And by putting those numbers into your model, you get a better sense of how your business is going to operate. How is it going to react to the environment? And in doing so, you can understand the risk. You might say the best case scenario is actually too risky for you because it might increase expenses significantly. And so as a young business, you don't know the business is still new to you, and you don't have that sixth sense, that gut feel as to how your business may respond, as it grows and it expands. So putting it in a forecast, developing a forecast, and looking at different scenarios helps you understand the risk factors that are involved with your business. Forecast is also a budget. A lot of businesses, they'll set up an annual budget. We're early in 2025 right now. And so a lot of businesses may have in December put together a budget for 2025. And that is essentially a forecast for, the 2025 calendar year. You can do a 1-year forecast that, is typically referred to as the budget, the annual budget. Some businesses also do 2 or even 3-year forecasts, and I'll talk a little bit about more in a few moments. It also allows you to kind of develop plans, around, kind of your operations and other factors. So you can develop plans, but looking at the forecast, how much raw materials do I need? If you're a food cart, how much ingredients do I need to purchase in order to meet this demand, in order to meet this volume of business? Your plans might call for hiring people. And again, with a forecast, you can assess how many people do I need to hire to support, this volume of business. And then, you can also use this to forecast inventory. If you're manufacturing food, chances are, you're making them in a batch, right? So you make, 1,000 jars of your sauce and it sits in inventory. Well, sitting in inventory has a cost and has an opportunity. So you want to be able to understand, manage, forecast your inventory, so that you can make plans around it, around storage, around marketing, around sales. And so being able to model or forecast inventory is key in terms of how you manage your business. And then finally, you need a forecast if you want outside capital. If you want a loan, the lenders, their number one question is, if I loan you money, how likely am I going to get the money back? That's their business. They loan money, and they make money by charging a little bit of interest, and that's their profit. And so what's critical for them is to evaluate, if you're seeking a loan, is to evaluate the likelihood of getting repaid. And if you're seeking a loan, the only way you get repaid, or a business can repay a loan, is if the business is profitable. So lenders will want to see that the business has sufficient profit to repay the loan. If you're seeking an equity investor, which is someone that buys share or an ownership in the business, they still want to do an analysis. They don't care so much about whether they get the money back or not, but they want to see how, am I earning profits? Is the business able to generate profits so I can get a return on my business? Or excuse me, in 10 years, right, is the business going to be able to grow enough so that, when the business is sold, I can make a sizable profit at that time. So venture capital equity investors, they look at the numbers from a different perspective, but it's still important for them to see, kind of a financial forecast um, to see how much potential return they can get. So let me pause there. And, before I talk about how to forecast, just, any questions about the basics, the rationale, the need to do forecasting.
And then before we ask some questions, let me pause the recording real quick.
So first off, if we have time, I will go into a template, and the template, that the QR code on the in the middle, the one that says English, that one I don't think. Well, don't use that one. Use the one that says English and Spanish. When you click onto that, you'll see a spreadsheet, and there are tabs that are in English, and then there's the exact same tabs that are in Spanish. So this is a template that you can use. It's every business. I'm asked all the time to develop a template that businesses can use for for their forecasting. And the challenge is, yes, I can do that, and the template that you can download here, does have some of that basics. But every business is so unique, so different that once you get the first round of numbers into it, it becomes a little bit of a challenge to customize the plan of the template to accommodate the specific needs of the business. So don't necessarily use this spreadsheet as something as like the master template. Use it as something that you can use, take, and modify to adapt to your needs. And the folks at Hacienda CDC can also help kind of tailor this to your business. Like I said, this version is very basic. I believe the version that you have, you can't edit, but if you kind of download or save as, or I think, make a copy, you can make a copy of this, store it in your own kind of Google Drive, and then you can play around, with it. So if we have time, I'll go through this in a little bit more detail, but I just want you to know that, this is a template that can give you an idea of, what a basic forecast looks like or can look like. So the first question I often get is, how far out should I, do a forecast? It could be anywhere from 1 year to over 3 years. And as a young business, I often don't tell or recommend people to do it more than 3 years, because at 3 years, it's really a guess. So much can happen, especially for a brand new business. You have no idea what's going to happen in 3 years, and it's not worth you spending any of your time trying to develop a 4 or 5 year forecast. So I tell people to kind of focus in on 1 year, and then maybe 2 or 3 years if you're inclined to do that. So the amount of work and effort that you do for each year, however, is different. So if you're looking at a 1 year, which is basically a budget, right? My recommendation is that is highly important. That is essential. You have to have an idea of what you're going to spend and what you are hoping to earn from revenue in the next 12 months. So I would say that is a high requirement, and that you should do a forecast every month. So every month of the year, you kind of just think about how much revenue am I going to have, how much expenses I'm going to have, and do a forecast based upon that. And you want to try to be as accurate as possible. So give some thought to every month, and in terms of the effort and the accuracy of the numbers that you're putting in. And this serves as your initial baseline for your forecast, but really it serves as your budget and your plan for the year. When you go to 2 to 3 years, I say it's important, but it's nice to have. Not must to have, it's nice to have. And that is, it sets a direction for your business. If you know that at the end of 2 years, in 2 years from now, you want to have a certain amount of revenue as your plans, or you want to have, your cost of goods sold at a certain ratio, um, you might have to do something, in the next 6 months to set the stage for those plans to happen. So having a 2 or 3 year, forecast allows you to kind of anticipate what you need to do to get to your goals 2 to 3 years from now. And that's the purpose of a 2 to 3 year. It sets direction. Gives you kind of a goal to go, pursue, in the coming months. And you can do this forecast on a monthly basis or even a quarterly basis. It just depends on your familiarity with numbers, how you like working with the numbers, and how much effort that you want. And I think these numbers, there's a little bit of a guessing. It's you're not kind of scrutinizing it as you might do for a 1 year budget, but it's you're putting some thought in. It's not a complete guess. And then, if you're going at 3 years or more, it's again, in my opinion, not critical. Any funder that you might be talking to, they know that the numbers 3 years and out is really a guess. So they don't put so much relevance to those numbers. So I wouldn't put that unless you're requested. And it's okay to do that on an annual basis. So I've seen forecasts where the upcoming year is every month, years 2 and 3 is every quarter, and then years 4, 5, and 6 are, just shows annual numbers. And I would say don't put so much effort into this. It's a guess. And again, it's just your North Star. It's your long-term plans of where you want to carry your business. So again, basically the moral of this story is that all time frames are not, created equal. So let me pause here, and now we're thinking about your business, right? What are some challenges that you all are thinking that as if you were told to put together a forecast, what are some challenges that you think you might encounter? And this is popcorn.
Feel free to just answer anyone. I will not pause the recording because I feel like this is important information.
And advisors, if you want to throw in a few words, feel free to get the ball rolling.
Mia?
So in order to create a forecast, do you need a book P&L, like just general bookkeeping history because it looks like it's everything is consolidated as a salary and it's monthly basically breakdown, right? So you need to have all the breakdowns, the P&L monthly, and then you implying into this forecast.
Yes, and that is one of the challenges for a brand new business. For existing business, right? Let's say you've been operating for 2 years, you have 2 years of historic financials, assuming that you've been doing bookkeeping. You have 2 years of expenses, 2 years of revenue that you can kind of project from and make some assumptions and plans based upon that. And you know how your costs are structured.
Sorry to interrupt you, Robin.
Yeah.
Can we first please explain what P&L is for those people who are not aware?
Profit and loss.
Thank you.
So profit and loss is the financial report that takes a look at your profit, the revenues that you earnings that you have, and then it subtracts out your expenses. And then the bottom line, shows if it's positive, that means you have a profit for your business. If it's a negative number, then it shows that you have a loss. And so profit and loss statement is, covers a specific period. So that's typically it's like a year. And it, has line items for each of your expenses and line items for each of your expenses. So for a brand new business, you don't have any historic profit and loss to work from.
Thank you. Anyone else? Advisors?
I have a question. If you've been operating for a few years and not doing a whole lot of like maybe bookkeeping or good record keeping of your profit and loss, would you suggest going back to kind of review what you've done, or should you just start fresh from where you're at? Like maybe what are the next steps when you're kind of knee deep in it halfway and you want to start doing financial forecasting?
Yeah, I think, having existing bookkeeping really helps. So again, another reason I know, none of you unless you're a CPA or an accountant, none of you go into business to manage your books. And it's probably the thing that most of you don't like to do as part of your business, but it's critically important if you want to manage the finances. But many businesses, have limited bookkeeping. And you could start from zero, having nothing. Maybe you've been around for business, and you know that from your tax returns, you know that your expenses, might be a certain amount. You know that your income revenue might be a certain amount, and it's a starting point. It doesn't have that much granularity or detail, but it's a starting point, and you can kind of work from there. Or maybe you can kind of go back and look into a little bit more detail and say, okay, I spent $50,000 last year. I know about $10,000 was payroll. I know that I'm paying $500 a month in rent, so that's $6,000 a year. You might be able to start breaking out some of those numbers just using some kind of back of the envelope assumption. So,
Another challenge
oh,
that came up
yes.
for startups, and specifically food and beverage industry, was the pandemic and planning for something like a natural disaster and the implications that stemmed from that, like supply chain issues. So I think that that could also be a challenge for startups.
Yep, you have no kind of history, and it's a scenario that most of us don't think about, right, when we're starting a business. But as we all know, it can be a reality. And it's how do you model that as an assumption? So yeah, that's another challenge. So I think the two things, other things. In the interest of time, I'll just kind of cut to the chase on a couple of things. One is it mentioned here no historic profit and loss. Oftentimes, when you do a forecast, you just apply kind of growth factors to what you did last year. And if you're a startup, you don't have it, all those numbers are zero, and zero times anything is zero. So it's difficult to plan, by saying, oh, I'm going to grow 10%, next year. I think the other thing is that you, as a young business, you still don't know your business. And you don't want, this is what I call the levers of the business. And to give you an example, when I had my business, after a few years in the business, I knew with a high degree of certainty that if I sent out a sales email in June, that I would get about 30% of my annual revenue in the next 6 weeks. I knew that with certainty. So when I developed my forecast, I could develop with high degree of confidence, the fact that I will send out that email in June, and that in June and July I would have 30% of my revenue from the prior year. As a young business, you don't know that, so you're still learning about your business. So, in terms of how to start, first you create a model. You can start with a spreadsheet and customize, that I provided, and customize it for your needs, right? If you are a manufacturer of a product, it's a very different financial model than if you're a food cart. So you need to kind of tailor it to your business, and I would anticipate that the advisors at Hacienda CDC have different financial models that they can work with. So start there. Create some assumption. A good assumption is, if you're a retail business, is kind of foot traffic. If you know that 500 people walk in front of your business every day, you might make an assumption that, okay, I'm going to try to get 5% of that foot traffic as customers, and that their average price or purchase is $10. So you have that assumption. It may be incorrect, but at least it's a starting point. It's a number, right? You do some multiplication, and you can get an idea of how much revenue you can do. So take those assumptions, plug the numbers into your spreadsheet, and you're going to have many different assumptions. You're going to have assumptions for revenue. You're going to have assumptions for expenses. And plug those numbers into your model, and then what I say is then you'll get some numbers and then validate it, right? Just because you put numbers into a spreadsheet doesn't mean that they're valid. The first thing is, what looks right, what looks wrong. It's what I call kind of the sniff test, right? You kind of get a sense, this seems too high or this seems too low. So take a look, take a step back from the numbers and look at them and say, okay, what seems right, what doesn't seem right? And the ones that don't seem right, kind of look at it a little bit more detail and see why it doesn't seem right. Um, do the numbers work? Meaning, do they align with each other? If you need 10 people to manufacture goods to sell $100,000 worth of product, and your forecast is showing that to generate $100,000 of sales, you need to hire 20 people. Those numbers don't align. You want to see if the different numbers in your model kind of align or match up with each other. You also want to test different assumptions, different scenarios, right? As a new business, all this is new to you, so you want to test. What if foot traffic doubles? What if your costs are in half? Just plug those numbers in and see what it turns out. And in the process of doing so, you're going to assess the risk. You're going to say, is this too risky for me? Is this scenario too likely, and is it too risky for me to run this business? And then the last thing is to really, take this model and review it with your advisors, your peers, your partners. You have a wealth of experience in this room and with your advisors, especially your advisors. They've seen hundreds of businesses. They have a good sense. Are these numbers realistic? Or are they achievable? So share those numbers, with them and say, what do you think? And they say, hey, this is reasonable, or they might say this is a little bit too aggressive, or this might be a little bit too conservative, and they can give you feedback that you can kind of incorporate in the model. This is, I think, probably the most important part of modeling for a young business, because you are new, you don't know how your business is going to operate, but your advisors, peers, and partners that you're working with, they represent the collective kind of experience of many businesses that can kind of allow you to hone in on your business. So you ask questions, you validate, right? And then you might say, okay, I got to change these numbers, make different scenario assumptions. And so you update your numbers, based upon the feedback and your validation effort, and then you repeat. So you update your assumptions, you put those assumptions back into the model, and you just kind of repeat it round and round, as often as necessary. And for a young business, it might take a while because you're still learning. You don't know what the valid assumptions or data might be. And then you'll get to a point where the numbers start making sense. Your advisors, your mentors are saying, yeah, this is solid. And then you can kind of go from that perspective. So that's kind of all I had to say. It's sometimes this presentation takes 2 hours. I kind of crammed everything in, but hopefully I covered the key basics of the presentation, or of the topic. Happy to answer any questions, or in the remaining 5 or so minutes, I can just talk a little bit about the spreadsheet if people want me to do that.
Does anyone have any more questions? Or perhaps anything of value that that you feel others should know as well? Maybe some challenges?
Yeah, I just wanted to add, when we were talking about the challenges, I think one of the challenges is to underestimate your expenses. And I have a client that open with like a very big menu, and that turns out to be very expensive if you're a business that is just starting. So then they had to do adjustments. So just it's one thing to keep in mind.
And that's yes, and I think that's the important part, that you do a forecast, you put in your expenses, and this is ideally all before you open your business. And I would say talk with an advisor, talk with someone who has experience in the business, and they're going to say, these numbers are off, it's way too low, way too high, and it will kind of, provide you feedback before you put in all that time, money, and energy to opening your business. And sometimes it might be a little bit too late to make some of those changes at that point.
I think I would add, related to that would be not knowing what your expenses are, like your cost of goods, the cost of ingredients. I know the next section is going to be cost of goods, but I think that's related.
Yep, so that's a great point, this says. So yeah, our next topic is cost of goods. So it's really related to this topic per se. So yeah, please stay in tune with that. Do we have any more questions or any comments? Anything?
Robin, if we have a minute to just quickly look at that template, I would love to,
Sure.
if that's possible.
We have about 5 minutes.
5 minutes, 4 minutes. Okay. Yeah. Let me pop that up. So you should all see a spreadsheet now. And I'm just going to kind of, again, there is English version and then Spanish version. So this annual forecast, this is the core part of this forecast. And it's organized by month, right? So the months of the year. And then there's a total kind of over here. And this is very simple business. There's your income, you have some online sales, and you have your retail sales, and you add them up, and that's your total income for the month. And then expenses, again, very simple. Some basic expenses that you may have, and you just kind of enter them in. And I'll show you in a moment how you might derive some of these numbers. And then, you subtract your income from your expenses, or expenses from your income, and then you get your profit, right? And the ones that are red, that means you've kind of lost money for the month. And the ones that are black means that you made, profit for the month. I did something else here, where I modeled the cash flow. Your profit and loss does not necessarily mean your cash flow. Your cash flow measures the amount of cash that you have available to pay your bills. And for young, simple businesses, oftentimes your profit and loss is equal to your cash flow. But if you start getting loans, if you have if your financials are a little bit more complicated, your cash flow, you could be very profitable but not have enough cash to pay your bills. And reasons why businesses go out of business is because they run out of cash. So doing a cash flow analysis, basically says, this is the amount of money I have in the bank at the beginning of the month. This is money. This is the profits, right? I'm in January. I made $7,900, but I spent $6,200. So my cash from operations or profit is $1,600, and then I pull out $4,000 to pay myself. And then you do that math, and you end up with $6,000 per at the end of the month, and that's your balance at the beginning of the month. And then you do that math again and again. And what this is showing you is in these months, where it's red, you're out of cash. You don't have cash to pay your bills. And so this alerts you. If this is January, you can say, oh, wow, in 3 months, I'm going to have some problems. And so this gives you some time to, address those problems. And maybe you can cut some expenses. Maybe you can do a sales campaign to try to drive up some sales, but allows you to plan and do things so that hopefully you stay cash positive at the beginning of the month, or for that month. So the first two, income, expenses, is profit and loss, and then this is cash flow. And then this talks about some assumptions. This helps you calculate some of the numbers, and these are some of the assumptions that I use. And here's one for online sales, and maybe I know I have 300 visitors per month. I know my conversion rate is 13%, and the average sale is $50. And so you do the math, and you get $1,950 worth of online sales for January, and you'll see that this number 1950, that's where that number is coming from. So this spreadsheet here shows how you calculate some of the other numbers that you put into the spreadsheet or into your forecast. So I can talk more about this, but I know again we're out of time. We're very have like a minute left. So I'll stop here, but you can kind of follow the formulas and see kind of what I did to kind of be able to pull up some of these numbers.
All right. So yeah, welcome back everyone. We will now get into cost of goods. This will be presented by David Hill. He will be telling you a little bit more about cost of goods, which is in relation again to the last presentation that we had the opportunity to listen to on financial forecasting. David, I'll pass over the mic to you if you want to introduce yourself, maybe share a little bit about yourself and your background. And
Thanks very much, Alex. I appreciate it. I'm happy to be here. I love coming and presenting this information to everyone. I'm going to share my screen. I have a few slides, and I think those will be available to you if you want them. Let's see. Let me share my screen.
Yep, we will be sending out both presentations in English and Spanish tomorrow via an email to all the participants.
That's good. Okay. And as Alex said, my name is David Hill. I'm here to present to you information about cost of goods sold and unit cost of goods. And this is in particular about food and beverage businesses. But frankly, it applies to just about every kind of business that sells some kind of product. But I'm going to gear this talk around food and beverage businesses. So as we go through, I will present a few slides, and then I'll stop for a minute or two and see if there are any questions before going on, and I'll try to do that. Sometimes it's hard for me to see if somebody has raised their hand or if they have a question.
We will be monitoring the chat and the reactions as well.
Okay, good.
If you do have a question that you don't want to forget, you can always put it in the chat, and we'll wait until he has an opportunity to answer. So that
sounds great. And I'll do my best to stop on a regular basis. I don't mind being interrupted at all, but like I said, sometimes it's hard for me to see when that's happening. So
of course.
Okay, so I'm assuming everybody can see my slides. Again, my name is David Hill. I'm the president of a company called Food Methods. And this company is one that I built, and I help food businesses in a variety of ways. My background is that I have a degree in food science and technology, and I have a degree in accounting. And I've worked in the food business for quite a while in a lot of different roles in food manufacturing. I've worked in food laboratories. I've done accounting, and I've done a fair amount of software development as well. My email address is on this slide. Feel free to email me if, after the presentation, if something occurs to you, you have a question or comment. I always like to hear from you. So don't hesitate to reach out to me if you have any questions. So as I said, we're going to talk about cost of goods sold and unit cost of goods. And these are two terms that are related, but they're not exactly the same thing. So cost of goods sold is probably what you've heard about most often, and that's the total cost of producing or buying, if that's the way you're operating your business, all of the products you're selling during a period of time. So, for example, if you produce a number of different flavors of something, you might want to know what the cost of producing all of those products is during, let's say, a month or a quarter or a year. Unit cost of goods, on the other hand, is the cost of producing, again, or buying one single unit of ready to sell product. So let's imagine you are making salsa. This unit cost of goods would be the cost of producing one unit of your salsa completely ready to sell. That's in the package with the lid, with the label on it. If there's a box, it's in the box. Whatever is required to sell that product to the customer, the cost of making it that way is the unit cost of goods. We're going to talk about both of these as we go through, but I just wanted to set the stage for these two terms and tell you that both unit cost and cost of goods sold include only the cost of producing the product. It doesn't include the costs of running the business or your marketing or your advertising, promoting the product, selling the product, only the cost of producing the product. So if you think about if you were purchasing food products from somebody else, what would it cost you to buy those products? Or if you're making the product, what would it cost you to make that product or manufacture that product? So as I said, we're going to talk about both of these terms, but I just wanted to get those straight from the beginning that they're very similar. They include the same thing, but they're a little bit different in their exact meaning. Any questions so far? I'll just kind of stop. Here we go and see if there's any questions. It doesn't seem like there are. We're good to go. Okay, so I'm going to the next slide. Now, this is an important topic, and it's one that I spend a lot of time helping people with who are in the food business, because it's important for all food businesses, food and beverage businesses that manufacture and sell products to understand what their unit costs are. It's a fundamental piece of information that is really essential for operating your business. Cost of goods or unit cost of goods can help you with a number of things. It can help you with setting your prices to make sure that you're earning a profit. When you do set your prices, it'll help you calculate that profit, and it'll help you manage your costs over time. So as you calculate and recalculate your unit cost, if you notice that the unit cost is increasing over time, that would alert you that some of your costs are increasing. So that's a good way of helping you manage your costs. It's also helpful to be able to recalculate your unit costs of goods whenever costs change. And I think we all know that costs change pretty frequently. So when a component of your food product changes its cost, you need to understand how that's going to affect your overall unit cost. Tax accountants, your tax preparers, your CPAs, they may help you calculate your cost of goods sold for the year so you can file your taxes. But most of the time, they don't help you calculate your unit cost of goods. That's usually up to you, the business owner, to calculate your unit cost. And it is very frequent that calculating both your cost of goods sold and your unit cost of goods, it'll require some estimating, sometimes even guessing at what some of those expenses are. So if you don't know all of the costs involved with your food product yet, that's okay. it's very common to need to estimate what those costs might be before you actually have good information. And that's absolutely normal. What happens is over time, you get more information and your estimates get better, and your unit cost of goods calculations become a little bit more accurate over time. But it's really common to start out needing to estimate things to a certain extent. There are a lot of different approaches and methods for calculating your unit cost of goods. And over time, you'll just want to pick the one that works best for you and stick with it. Choose one that you're most comfortable with. The way I do it is one way, but there's a lot of other ways to do it too. And so I'll take you through the way that I find is easiest, and then that'll help you make your decision later on. So first, we're going to talk a little bit about cost of goods sold. And as I described earlier, that's the amount of money you spend during a period of time to produce the products that were sold. So that would either be producing the products yourself, or if you're buying products, that's the total cost of all of your products over time, in a period of time, to get those products. The cost of goods sold is what I call a back-looking number, in that it looks at expenses that have occurred already, that have already been incurred in the past. So an example would be, let's say you're a food business owner and you sold 90 units of your product last month, and you want to calculate the amount of money it costs to produce those 90 units. You would simply look back and add up all of the costs spent to produce the products that were sold during that period of time. And you wouldn't want to include the cost of products that are still on hand, like on the shelf or something, during that are there during the end of the month, only the ones that are sold. On the other hand, unit cost of goods is the amount of money it would cost to produce 1 unit of your ready-to-sell product. And I refer to this as a forward-looking amount. It's a forward-looking estimate of the cost of producing 1 unit of your product. So where cost of goods sold is the amount that it costs to produce all of your products during a period of time, unit cost is the cost of producing just 1 unit. So if you're selling potato chips, what's the cost of producing 1 bag of your potato chips, or 1 jar of salsa, or a jar of mustard sauce? Whatever your product is, you want to calculate the cost of 1 unit of your product. It's really important for business owners to know the cost of producing their product. It's an essential piece of information. So for example, let's say a food business owner plans to sell packaged food products, and that could be anything that you see on the shelves. But if you want to calculate the amount of money that it will cost you to produce 1 unit of that ready-to-sell product, you would estimate the cost of all of your ingredients, packaging material, the labels that go on the package, any production labor, any workers that you have, and the kitchen rent for the cost of kitchen rent. And then you would calculate that for a single unit of product. We'll go into an example of how that can be done for a single unit of product in just a minute. So any questions so far before I move on? It sounds like we're doing okay. Now, here's a note about restaurants and food carts and any kind of food service like caterers or any other food service operation. Unit costs of goods a lot of times don't apply to restaurants and food carts. It applies mostly to businesses that sell products. And the reason for that is that restaurants and other food service operations can find it pretty challenging to calculate their unit cost of goods. When you're selling food at a restaurant or a food cart, sometimes there's substitutions in the order. You might have condiments available, labor costs, and things like that make a unit cost difficult to calculate. So, generally speaking, those businesses just have categories of costs. They calculate their food costs, their labor costs, and then what are sometimes called house costs. That's the rent and utilities and everything else associated with operating the restaurant itself. So it's regardless of what type of food business you're running, it's really important to be able to monitor your costs. And that's one of the big takeaways of my talk this evening is to encourage you to think about your costs as much as possible. Any questions before I move on? Okay. I do have a few recommendations when it comes to calculating your unit cost of goods. The first thing is I really encourage you to develop your recipe so that it can be made consistently every single time. And there's a lot of reasons for this, and it might be common sense, but it's worth mentioning anyway. Your consumers will come to expect a certain product and the way it is every time. So you'll want to be able to make it consistently. Not surprisingly, this can make it a lot easier to calculate your unit cost of goods because you know that it's done consistently every time. So the way I go about calculating unit cost of goods is first I calculate the cost of producing a batch of product. And what I mean by a batch is that's like if you're, for example, making salsa, you put all the ingredients in a big pot and mix it up and then dispense it to individual packages or jars. So that's the way most food operations work, is they prepare things in big batches. And then my recommendation is to divide that batch cost by the number of units that the batch makes, and that will tell you your unit cost. So I found that it's a lot easier to approach things that way because it's the quantities of ingredients and the number of packages and the labor involved. It's a lot easier to calculate how much is required to make a batch of product and then divide that batch cost by the number of units in the batch. Then it's a lot easier doing it that way than taking every component and trying to calculate individual unit sizes for each ingredient and things like that. Spreadsheets like Excel or Google Sheets, they can help you in your efforts to calculate unit costs of goods because it can make the calculations easier. You don't have to punch things in a calculator. You can just put the numbers in a spreadsheet, and that can sometimes make things a little bit easier. I often find that it's also easier to weigh all of your ingredients rather than using measurements like teaspoons or cups or tablespoons and things like that. The reason is because doing ingredients by weight is a lot more consistent, and you'll find if you are putting things in measuring cups and things like that, one person may put more than the other person, and so it comes out to be a little bit less consistent than if you weigh your ingredients. So that's something I strongly recommend, is weighing your ingredients. I weigh my ingredients in my home because it makes me a better home cook when I weigh all my ingredients rather than using cup measurements and teaspoons and things like that. It's definitely good. It'll make your products more consistent, and the math will be easier too, I think.
David, I just want to add to that. It also helps with scale up. So as folks want to start making larger batches, weight is going to be a much more accurate way to produce your product than using measurements. So another added advantage to using weight over measurements.
Absolutely. That's a really important point. So thank you very much for bringing that up. I sometimes give workshops for other groups, and occasionally I'm asked about scaling a recipe for a production situation. And that's the first thing I say is you got to weigh your ingredients in order to scale it, because it's really difficult not to weigh your ingredients. You can try this fun thing at home. Take some brown sugar. I like brown sugar because it can either pack down or it can be very loose. So if you try to put a half a cup of brown sugar, everybody who does that is going to come up with a different weight that is in that half cup measurement. So that lets you know right away that measuring using measuring cups and teaspoons and things like that can end up with a lot of variation. Weight is weight, and it'll always be the same amount. But so there's a lot of reasons, as you said. So thanks for that comment. I appreciate it. When you set out to calculate your unit cost of goods, and this also goes with calculating your cost of goods sold, you'll want to include certain things in your calculations. One, I think it should be obvious, is the ingredient costs. So that's all of the ingredients that are used in making your product. There are some products that need what I call production ingredients, which are not, they don't end up in the product, but like if you're making a baked product, the flour that goes on the breadboard, or if you're using some kind of a lubricant to get your products out of a mold, for example, you'll want to include those production ingredients as well. But all of your ingredient costs would be included in cost of goods, as would be packaging. So this would include any jars, lids, boxes, bags, any kind of tape or glue that's used in applying labels to boxes or putting the labels on, anything like that, any kind of packaging that's associated with your product. You'll want to include that packaging material in your cost of goods to make sure that you're accounting for everything. I mentioned product labels already, but sometimes labels can be expensive, so you'll definitely want to include product labels in your cost of goods. Some products have a label up front and a label in back, so that would be two labels. You want to account for both of those. And you'll want to include production labor. And I have a note here to always include some kind of estimate for your own labor, even if you aren't paying yourself yet. And that's an important point, because there may come a time when you are able to hire somebody to work in the kitchen so you can work on other parts of your business. You don't want to have the addition of that worker suddenly increase the cost of goods that you've calculated where it wasn't included before. So include something for your own labor in your calculations so that you have done the appropriate planning for the time when it comes to hire some additional workers. And then you'll also want to include kitchen rent in your calculations for cost of goods. Frequently, commercial kitchens are rented by the hour, and so you would want to estimate how many hours it would take to make a batch of your product, and that's where you would start with the estimate for kitchen rent. Any questions about what to include in cost of goods? So if you think about what would occur if you purchased your products rather than made them yourself, it would not include the cost of, say, advertising or office supplies or your website or people that you've hired, your bookkeeper or other professionals. It would not include your business license, any other non-production costs that are associated with your business would not be included in your cost of goods because they're not required to produce your product. They may be required to operate your business, and that's a given, but if they're not required to manufacture your product and get it completely ready to sell, then you would not want to include that in your cost of goods. It's sometimes tricky to determine what to include and what not to include, and that's normal. You just have to use your best judgment, and over time you'll come to a decision about what to include and what not to include. There are several ways you might go about finding the information to include in your cost of goods calculations. One is if you've been purchasing ingredients or purchasing materials, look at your receipts and invoices, and it generally will give you the information you need for that particular item or that particular material. Sometimes, if you haven't begun business yet, you can acquire price lists from suppliers, and that may help you a lot in estimating your unit cost of goods. Even before you go into production, you'll have a better idea of what it might cost you. You will want to include wage information for your workers. So if you ask around at what a general fair wages for your workers, that would be the dollar amount that you would want to include in your labor costs for calculating your unit cost of goods. And as I said before, and I think this is really important, include something for your own labor, even if you're doing all the work but not getting paid yet. You'll want to account for that and plan for it. So include something, just a fair, whatever it would cost you to have somebody else come and do what you're doing, that's what you would include in your cost of goods. It's very common to need to estimate your individual cost. Just base it on reasonable information, ask around, look at receipts and check websites, anything that you can think of that might give you a good estimate for the information to include is fair game. Now I have this slide in here just in case you don't like math, and I know a lot of people don't like math, and it's very common, and I'm here to say sorry, because math is going to be involved in calculating your cost of goods. There's really not a way around that. The good news is the math involved in calculating your cost of goods is not super complex. And once you get dialed into the calculations, you just do those calculations over and over again, and you'll get used to them pretty fast. It's really just mostly addition and subtraction, some multiplication and division. But other than that, the math isn't too complicated. And really, you should know that running a successful food business, really running any kind of business, is going to require some math. But it's not that difficult. And I encourage you to get help if you have difficulty. There's a lot of help available for this kind of thing. Heck, email me if you need help. I can help you. But there's a lot of help available if you need to. So if you're a math avoider, just set that aside and charge in and you'll be just fine. So don't worry too much about that.
Awesome. David, there are some questions in the
Yes.
chat. Someone said there are food trucks class IV that don't need to rent a commercial kitchen, could you add propane gas, water, electricity to the cost of goods?
Let me just read that. So class 4, food truck, commercial kitchen.
I think this is something that you were saying about earlier, that like for businesses that are not doing like a packaged good, that you would just have a category for this cost. Is that correct?
Yes, yes. So that would be like your monthly truck cost would be the propane, the water, the electricity, the hookup, the rent, the spot, anything like that. For a food service operation like a food truck or a restaurant, that's exactly how I would operate it or approach it, would be to include that as part of your house costs. Again, it's pretty common. Restaurants go about it a little bit differently than product businesses. They just do their food costs, their labor costs, and their house costs. So I think you're right on track with that. Propane, water, and electricity. It's a little bit. I think it's a little bit different than cost of goods, but it's definitely monitoring the costs of your business. So that I think you're definitely on the right track there. So another question about delivery costs. So I get this question a lot, and I think of delivery as inbound. So if you're purchasing ingredients from a seller and you also have to pay shipping to get that ingredient to you, then yes, you would include the delivery in the shipping costs in your ingredient costs for that particular ingredient and include that in your cost of goods, your cost of goods. So those are excellent questions. So to deliver this final product to a store to sell it, I'm mixed on that. Now I'll tell you why, because sometimes all of your products need to be delivered to a store. And so I think if that is a cost of doing business, then it's fine to include that in your cost of goods so that you can price your products accordingly to cover that delivery fee to, or the delivery cost to a store. It gets tricky making that broad statement, because there's certain situations where where it's rare that you would have a delivery cost. And so in those cases, you might decide not to include it. You kind of have to use your best judgment on that. There's not a completely right or a completely wrong answer for delivering the final product. For instance, if you're selling direct to consumers, say online over your website or something, a lot of times the consumer is paying for shipping to them, and sometimes they're not. So it depends on the situation, but frequently it can be included. But I'll also tell you it's a little bit hard to calculate. So you would want to use your best judgment on that. Sorry, I can't be a little bit more precise on it without knowing all of the particulars, but that is really a judgment call. So something that you have to take into account. Is distribution. So that's a good question. Distribution cost versus delivery cost. When I think of distributors in the food business, I usually think of companies that buy product from you and then sell it and deliver it to the grocery stores, rather than having you deliver the product directly to the grocery store yourself. So yes, there is a difference between distribution costs and delivery costs. Distribution is a broad topic, and I wish I had a lot of time to talk about that tonight. Unfortunately, I don't. But there are specific distributor companies that handle food products, and they would not be included in your cost of goods sold. That's a separate way of accounting for those businesses that buy product from you and then resell it to grocery stores. Delivery costs, as I mentioned earlier, occasionally they can be included in cost of goods. Frequently they're not. It depends on your situation. And I will tell you that there is not, for calculating unit cost of goods, there's not 100% correct way or 100% incorrect way to do it. It's just sometimes requires judgment on your part. Should I just sum up and give some percentage into COGS? That's one way to do it. You have to be careful that you're later on, if you're estimating a percentage, you'll want to double check from time to time to improve the percentage accuracy that you're using to include in that. But that's a good question. I would definitely start with the ingredient costs, packaging and labels and labor and facility costs before worrying too much about delivery costs. But it's really good to keep those things in mind, particularly if they end up being a significant part of your operation and production operation. So as I said, I wish I could spend more time talking about distributors. I'm not sure if that's part of this program or not. It's sometimes something that businesses encounter later on after they've been in business for a while, rather than immediately when they start their business. So at least you'll have some time to kind of investigate that and learn more about it. I'm going to continue on with the slides.
Thank you.
And we're going to go through, those are great questions, by the way. We're going to go through a simple unit cost of goods example, and we're going to start by calculating the cost of producing a batch of product, and then we'll divide the batch cost by the number of units in the batch. And in this example, we're not even going to say what product it is. I'm not going to go all through that level of detail, but just pretend for this example that when you mix up a batch of your product, it makes 25 units of what you're selling. Yours will be different, probably. I don't know. This is just for an example of 25 units. So we'll start with ingredients. And I'm just going to go through one ingredient, and let's assume that this product requires masa harina. So let's say that we can purchase the masa flour for $21.25 for a 25-pound bag. So if you divide the $21.25 that it costs to purchase that bag, and there's 25 pounds in it, each pound would cost 85 cents. So you're simply dividing the total cost of the bag of the masa flour by the number of pounds in it, 25, to get the 85 cents per pound. Let's say then that the batch recipe requires 5 pounds of the corn masa flour. So the 5 pounds would cost us $4.25. And we come up with that because we've already calculated 85 cents per pound, and we know we're using 5 pounds. So the batch cost for that one ingredient would be $4.25. Most food products have multiple ingredients, so you would go through this with each ingredient to arrive at the batch cost of that ingredient, and you keep doing it for all the ingredients in the product until you come up with a batch cost for all of the ingredients, the total batch cost of ingredients. So as I said, we're not delving too deeply into this. We'll just assume that this is the ingredient in our product and that the batch ingredient cost is $4.25. But again, your costs will be different. The way you use ingredients will be different, more than likely. And so you would just want to do this for each ingredient and then add them all together. I'll also say, ingredients are one of the hardest things to calculate because they usually come in big packages. They're usually a different weight than what you need for your product. And so it's not uncommon to spend most of your time calculating ingredient batch costs or ingredient costs. And that's not uncommon at all. So, but ingredients are the ones that always require the most work. Packaging, not so much. A lot of times you get pretty good information about package costs. So we're going to say, let's say that this package, each package would cost 45 cents. And it depends on how you're buying it, who you're buying it from, but the calculation of a per package cost should be pretty straightforward. And that goes for the labels too. So for this example, I'm saying 45 cents per label. 45 cents per package and 35 cents per label. And again, earlier I said that the batch would make 25 units of product. So the batch is going to require 25 packages and 25 labels. So again, we would calculate the batch cost of packaging and labels. So in this case, 45 cents times 25 is $11.25. We've done the same thing for the label. 35 cents times 25 is $8.75. Adding those together, we get $20 for the batch cost of packages and labels. And then later we'll add our ingredients to that. But we're going to continue on with labor. And again, it's ingredients are always the most complicated, followed by packaging. Labor, not so complicated. Let's say we know that we would pay our workforce $15 an hour. That may be a little low for today's wages, but we'll just pretend that that's what we would charge, what we would pay, $15 per hour. And for this example, we'll say that the batch requires 2 hours of labor. And that includes setting up everything and cleaning up after the batch is made. So that's $30. 15 times 2 is $30. And if you have multiple workers, you would do this for each worker that's working in the production component of your operation. And again, include your own labor. Even if you're not paying yourself yet, you want to put something in there for labor costs for yourself. And then finally, let's pretend that our kitchen rent costs us $18 per hour. That again might be a little low by today's rental. I don't know. But we already said that it takes us 2 hours to make one batch of our product. So $18 per hour times 2 hours is $36. Pretty straightforward. Then we would add up all of these different components, the ingredient batch costs of $4.25, packaging and labels, $20, labor, $30, kitchen rent, $36. We would then divide the total batch cost by the number of units that we manufacture in the batch. So if we add the $4.25 to the 20 and all of those things, we come up with $90.25 to produce one batch of our product. But then if we get 25 units out of our batch, then we would divide the $90.25 by 25 to get $3.61. And that would be what we would consider our unit cost. So I think there might be a question. Alex, should I look in my chat real quick to see? Total is 20. Oh, I see. Okay. Somebody corrected there. Yeah, sorry. So yeah, I did my best to try not to mix the numbers together and be confusing, but yeah, the number of units in this example was 25. It just so happened that the packaging and labels added together cost $20, but I think you caught that too, so I think we're good to go. So again, we calculate the cost of ingredients, packaging, labels, labor, kitchen rent. We add it all together to make one batch. Then we divide that batch cost by the number of units our batch makes. So in this case, our unit cost of goods would be estimated at $3.61. So depending on what our selling price is, hopefully it's more than 361, we would be able to calculate the profit that we would earn by selling 1 unit of product and so on. So this is how I go about it. I found this to be very straightforward for people to use when they're calculating their unit costs. One closing thought is that it's better to have an estimate of your unit cost of goods and be a little bit off than it is to ignore it because you're afraid you're not going to be accurate about it. It's by far better to have a rough estimate than just ignore it altogether and not have any idea at all. And then over time, better information will come in. Maybe you'll get a more accurate cost of one of your ingredients, or something better information comes to you. You can put that information in your estimates and recalculate, and that improves the accuracy of your unit cost of goods over time. So hopefully you will take this information and start out early in your business estimating what your unit cost would be, so you can evaluate for yourself if this is going to be a viable product, or if it's something you want to figure out how to get your cost of goods lower so that it does generate a profit for you. Any more questions about this?
Yeah, I have a quick question.
Yeah.
So for certain like raw materials, like the price can change a lot, like during the course of a year, let's say. Like how often would you recommend someone to like redo this exercise and like go see what is the new price of the thing, so you can update your cost of goods?
That's a great question. And of course, there's no right or wrong answer on that. I would say, for one thing, it depends on how much the cost of something is changing. If a supplier lets you know that something is just going to go up a few cents, maybe you're not going to be too worried about that right away. But if another supplier says, hey, our costs are increasing 50% over what you bought it for last time, that could have a serious impact. So one thing that a lot of people do is whenever they get information about a change in a cost of some of their components, they recalculate their cost of goods to know if what they're selling it for is still going to generate their profit that they're expecting. It's typical to recalculate your unit costs frequently, but then only raise your prices occasionally, because the stores who are buying your products, or the customers who are buying your products, they need a little bit of consistency. So you want to build into your pricing the possibility that costs could go up a little bit, and then maybe every 6 months, every year, reevaluate if you are charging your customers or charging your buyers enough to cover not only your costs, but to generate an appropriate profit for you. So excellent question. no real right or wrong answer. I would do it all the time because I would use a spreadsheet and I would just type in the new number and voila, that is my new cost of goods. Am I still making a profit? Yes, I am. So I'm not going to worry about raising my prices just yet. But recalculating on a frequent basis is it can never hurt if you recalculate. So, and you'll get used to it over time. So it gets quicker.
And I have another really quick one.
Yeah, sure.
So you mentioned that like the operating costs of the business are not included in the COGS. But like for people that like, what calculations should someone have in mind when they are, because it is a cost, like trying to cover for that with the sales of their products?
That's a good question. And again, it's not an easy question to answer, but you also have to take into account some kind of estimate of the volume of the product that you think you'll sell over a year. And so if you believe that you'll sell X number of units of product, will the amount of profit from selling those products cover your estimated operating expenses and put a little bit of extra money in your pocket as well by way of owner profit? That's the kind of thought process you would go into in setting your prices is, can I set my prices not only to cover the cost of goods, but to cover all of the business operating expenses as well? And that's as much art as it is science, because you have to balance that against what you expect customers would be willing to pay. And sometimes that can be surprising, but sometimes you have a pretty good idea of a maximum that you could charge for your product. And then you have to ask yourself, how much can I sell over time and will that cover my operating expenses? So great question. I'm not sure if I answered it very well, but I'm really good at dodging those kinds of questions when I need to.
No, that was great. Thank you.
Okay. Well, I think we may have come to the end of our presentation, for my part anyway. These were excellent questions. I really enjoyed being here, and I wish all of you the best of luck in your business.
Thank you so much, David. It was a pleasure having you. Let me go ahead and